Good morning, everyone. This is Marshall Giller bringing you the morning comment for November 11th. Investors yesterday realized that they'd indeed gone too far, as I thought, and reversed much of Friday's action. The Fed funds futures rate expectations regained half of what they lost on Friday, as did 10-year yields. Yet, the stock market managed to gain a bit, indicating that the rise in yields was due to expectations of stronger growth, which is good for the dollar. Under such circumstances, the dollar rallied against almost all the currencies we track, which is exactly the reverse of Friday's action. There doesn't seem to have been any specific trigger for the reversal, just a general sense, which I share, that Friday's moves were overdone in relation to the payroll data. My view remains that investors should pay more attention to the FOMC's forecast for interest rates, which are substantially more aggressive than the markets, and that the gradual repricing of market expectations upward is likely to offer continued support for the dollar. Now, one possible point of concern, once again, it looks like extreme weather is headed towards the U.S. A polar vortex is forecast to descend on the U.S. this week. This is worrying to me personally, since I'm forecast to go to the U.S. next week. The cold could slow the economy, damage crops, and cause at least a temporary spike in the oil price. But I'm an economist, I'm not a weatherman. Please watch the weather reports about this. Now, we've got a light economic calendar today. Japan's current account surplus for September already came out. It unexpectedly rose sharply due to a larger than expected rise in income. The trade deficit also narrowed. Oddly enough, the news sent dollar-yen higher, or dollar-yen moved higher despite this. One possible explanation, the Bank of Japan announced a small purchase of Japanese stocks after the market closed on Monday. That might have boosted stock prices today, and thereby sent dollar-yen up, since the two are positively correlated. But it's unclear. We have no major indicators coming out today from the Eurozone nor the UK, while the US government's closed for Veterans Day, although exchanges are open. In Sweden, the Riksbank releases the minutes of its October policy meeting when it cut its key repo rate to 0. We also get the country's CPI and one of its unemployment measures. I think the market's going to focus mainly on the CPI reading, and the Swedish krona could weaken as a result. The only indicator coming out from the U.S. is the NFIB Small Business Optimism survey for October. It's expected to have increased fractionally, which would keep it near its highest level since October 2007. The indicator isn't particularly market affecting, though. During the late U.S. session, which will be overnight in European time, the RBNZ, the Reserve Bank of New Zealand, releases its financial stability report. The market will look for any hint from Governor Wheeler about the time frame they expect to remain on hold. If they again try to talk down the Kiwi, I think Kiwi dollar could fall back to the key support line of 0.77, the figure. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.